Good morning. I would like to welcome everyone to the FTG Q2 2026 analyst call. All lines have been placed on mute. There will be question and answer session following the call. If you would like to ask a question during this time, simply press star followed by 1 on your telephone keypad. If you would like to withdraw your question, please press star followed by 2. Please note that this call is being recorded. I would now like to turn the call over to Mr. Brad Bourne, President and Chief Executive Officer of FTG. Mr. Bourne, you may proceed.
Thank you. Good morning. I'm Brad Bourne, President and CEO of Firan Technology Group Corporation, or FTG. Also on the call today is Drew Knight, our Chief Financial Officer. Before we go any further, I must caution you that this call may contain forward-looking statements. Such statements are based on the current expectations of management of the company and inherently involve numerous risks and uncertainties, known and unknown, including economic factors in the company's industry generally. The preceding list is not exhaustive of all possible factors. Such forward-looking statements are not guarantees of future performance, and actual events and results could differ materially from those expressed or implied by forward-looking statements made by the company. The listener is cautioned to consider these and other factors carefully when making decisions with respect to the company and not place undue reliance on forward-looking statements. The company does not undertake and has no specific intention to update any forward-looking statements, written or oral, that may be made from time to time by or on its behalf, whether as a result of new information, future events, or otherwise. Our second quarter was a record quarter for FTG on virtually every metric. We had record revenues, record earnings, record bookings, and record backlog, with continued strong end market demand. More specifically, in our second quarter of 2026, we achieved the following. Bookings were $86.7 million in the quarter, our best ever bookings in a single quarter, and an 89% increase over Q2 2025, resulting in a book-to-bill ratio of 1.64 to 1. This included additional bookings on the 2 classified defense programs we have previously mentioned. But to be clear, bookings were strong across our business, not just on these 2 programs. The quarter-end backlog stood at $193.5 million, a 30% rise from the previous year-end. Revenue was $52.7 million, again our best ever quarter, and an 8.2% increase over Q2 2025. Adjusted EBITDA was $10.5 million in Q2 2026, a record high, up 20% from $8.7 million in Q2 last year. Adjusted net earnings were $5.1 million in Q2 this year, an increase of 44% from Q2 last year, and another record for FTG. This once again demonstrates the top-line growth drives profitability at FTG. Free cash flow was positive $2.7 million in our second quarter, and we maintained a strong balance sheet with net debt down to $2.9 million, or 0.1 times trailing 12-month EBITDA. Most of our debt is government loans. Other accomplishments in our second quarter included, in 2025, our circuits business qualified for 2 large-scale classified defense programs, and significant orders have been placed for these 2 programs during Q2 this year. Only one of these programs had any revenue in our second quarter, and it was not significant. FTG Aerospace Calgary continued to benefit from efforts to certify and sell its product portfolio globally, and had profitable results again in the quarter. I will talk more on this later. Our efforts to reduce our exposure to U.S. tariff risk continue, and in Q2 2026, our efforts continued to sell outside the U.S. Deliveries to China's C919 program continue. In addition, deliveries to the new de Havilland Canadair 515 aerial firefighting aircraft started to ramp up. More deliveries on both these programs are expected to continue in the second half of 2026. We also made more progress on moving non-U.S. customer orders to our non-U.S. sites to further reduce our exposure to any tariff risk. And finally, we had some larger orders for circuit boards from a Canadian customer. But offsetting this was continued strong demand coming from the U.S. market. Drew will provide more details on our second quarter results shortly. Let me turn to some external items. Our end market demand remains strong. Airbus is targeting 870 aircraft deliveries this year, up about 10% from last year. But more importantly, they're looking to ramp to over 1,000 aircraft annually in the next few years. Airbus has a backlog of over 8,000 orders, which is over a decade worth of production at current production rates. At Boeing, they shipped 600 planes last year, up from 350 in 2024. But looking forward, Boeing has plans to ramp their production to over 800 planes annually in the next few years. Boeing's backlog is about 6,000 planes, so also over a decade's worth of orders at current production rates. In the business jet market, Bombardier reported a high single-digit shipment increase last year. They're also pushing hard to add a defense component to their business, and they've had some success to date in selling their business jets for defense applications, including a NATO award this week for surveillance mission aircraft. In Q1 this year, Bombardier sales were up 5%. In the helicopter market, Bell Helicopter reported a 20% increase in revenues last year, driven by increased defense programs. In the first quarter of 2026, revenues were up 9%, again on increased defense activity. All of this bodes well for us as we look to future demand in the coming years. Defense spending is expected to increase going forward. The U.S. budget request for next year is for a 50% increase in spending to about $1.5 trillion. There are new commitments from all NATO members, including Canada, to ramp defense spending to 3.5% of GDP, with another 1.5% for defense infrastructure. Canada increased their defense spending in 2025-26 to 2% of GDP. All of this indicates significant increases in defense budgets for all European countries and Canada. The recent creation of a defense investment agency in Canada to accelerate and streamline future defense procurement activity is positive for the industry here. Looking at the longer term, Boeing's most recent 20-year forecast for commercial aircraft shows significant long-term industry growth, and it continued to show 28% of all new aircraft deliveries going to China and close to 40% to Asia, as has been the case in all of their recent forecasts. A recent business jet market forecast from Honeywell similarly predicts growth in this market of 5% this year and 3% annually over the next decade. So, as we have said for many years, FTG's goal is to participate in all segments of the aerospace and defense markets as each moves through their independent business cycles. It is not often all segments are growing, as is the case right now. Beyond all this, let me give you a quick update on some key metrics for FTG for our second quarter of 2026. First, as already noted, the leading indicator of business is our bookings or new orders. Our bookings were almost $87 million in the quarter. This resulted in a backlog of over $193 million at quarter end, even after record shipments in the quarter. Q2 sales were $52.7 million, which is up 8% over Q2 last year. In our aerospace business, sales were up 21% in Q2 to $17.1 million compared to Q2 last year. Sales in Toronto, Tianjin, and Calgary were up, while activity in Chatsworth was down in the year due to timing of some orders. The growth in aerospace was in spite of some challenges on our C919 program in China, where we had to deal with some sizable customer concerns and returns, including some shipments that arrived at the customer with water damage to the shipping containers. In this case, the good news was when we took the product back and inspected and tested them, none of the product itself was damaged. But this took a lot of time and energy for our plants in Tianjin and Toronto to support our customer and get the product returned successfully to them, and still they had a strong quarter. Calgary saw strong revenues from hardware sales, which were mostly SATCOM radios delivered in Canada and the U.S., but also from our second delivery of Edge Plus WQARs in Asia. Data sales were also strong due to SATCOM radio data, but also an increase in weather data for NOAA. Licensing revenues were again from our SATCOM radio, which were very strong in the quarter. On the circuit side of our business, sales in the quarter were $34.3 million, up 1.9% over Q2 last year. Our two largest sites were down slightly in the quarter, but the other sites more than offset this. Circuits Toronto was down to an operational disruption mid-quarter, and Circuits Minnetonka was down due to a product mix shift towards higher technology product and by labor constraints. But by quarter end, Minnetonka had made strong progress on staffing, which will benefit them in the second half of the year. On the positive side, our Circuits Fredericksburg site almost doubled their revenues in our second quarter, with work transferred from Minnetonka, and with no change in their staffing levels. They truly had an amazing quarter. While our two largest sites did not grow, Fredericksburg was up over 90%, Chatsworth was up 18%, and our Haverhill site was up 15%. Overall at FTG, our top 5 customers accounted for 51.2% of the total revenue in Q2 26. This compares to 52.8% last year. Airlines were 3 of our top customers in the year due to the flight acquisition. Also interesting to note, of the top 10 customers, 5 are customers shared between circuits and aerospace, and 2 are former flight customers. Given the actions of the new administration in the U.S. of implementing tariffs, it's also good to see that 2 of our top 10 customers are outside the U.S., with 1 in Canada and 1 in China, and another 6 have operations outside the U.S. While on this topic, 70.3% of FTG sales are to U.S.-based customers in 2026. This includes sales by our U.S. sites as well as sales from sites in Canada or China. This compares to 69.7% last year. While sales grew by 10% in the U.S., they also grew by 4% in Asia and by 44% in Canada, as we benefit from previous efforts to expand globally, including things like our content on C919 aircraft in China and acquiring Flight with sales globally. Sales decreased in Europe by 8% in the quarter. Sales outside the U.S. are helpful in the event of any tariff that the U.S. might impose on our non-U.S. based sites. Our goal is to continue to grow our non-U.S. revenue for our non-U.S. sites. In Q2 2026, 35.8% of total revenues came from our aerospace business compared to 32% last year. I'd now like to turn the call over to Drew, who will summarize our financial results for our second quarter of 2026, and afterwards I will talk about some key priorities we're working on. Drew?
Thanks, Brad. Good morning, everyone. I would like to provide some additional detail on our financial performance for Q2, starting with revenue and gross margin. On sales of $52.7 million, FTG achieved a gross margin of $19.2 million or 36.5% in Q2 2026, compared to $15.9 million or 32.6% on sales of $48.7 million in Q2 25. The increase in gross margin dollars is based on top-line growth, while the gross margin rate increased due to operational improvements in multiple facilities despite unfavorable FX variances. The improved profitability at Aero Calgary and several U.S. sites has a substantial impact on consolidated margin rates. Aero Calgary continues to benefit from its ongoing licensing revenue that resumed in 2026, as well as repeat hardware sales of its AFIRS Edge product. The U.S. sales improved margins via increased throughput with limited added resources. Moving on to SG&A. SG&A expense was $8.4 million or 15.9% of sales in Q2 2026 as compared to $6.8 million or 14.1% of sales in the prior year. The increase of $1.55 million during Q2 was primarily due to performance compensation tied to profitability, amortization of deferred financing costs, and some corporate admin costs of the new leadership team. Now speaking to R&D. R&D costs for Q2 2026 were $2.8 million or 5.3% of sales compared to $2.4 million or 5.0% of revenue in 2025. R&D efforts include product and process improvements at the circuit segment, as well as aerospace segment product development and product process improvements. Regarding foreign exchange, FTG is exposed to currency risk through transactions, also assets and liabilities recorded in foreign currencies, and finally from foreign subsidiaries' translation of financial statements for consolidation. The average exchange rate experienced in Q2 2026 was 1.373 on the US dollar as compared to 1.407 in 2025, which equates to a weakening of the US dollar by 2.4%, and this hurts results for FTG. Moving on to profitability and EBITDA. Adjusted EBITDA, as detailed in the MD&A, was $10.5 million for Q2 2026, or 19.9% of sales, compared to $8.7 million, or 17.9% of sales for Q2 2025. As noted with gross margins, the year-over-year comparison of adjusted EBITDA is improved $1.78 million over Q2 2025 as a result of growing the top line organically. Operational improvements in the U.S. plants and Aero Calgary revenue streams added in 2026 for Edge Plus and licensing. Regarding earnings, for Q2 2026, FTG recorded net earnings of $5.0 million or 20 cents per diluted share as compared to $3.5 million or 14 cents per diluted share in Q2 2025. The earnings comparison to prior year was improved by favorable income taxes based on the distribution of profits in 2026 being more widespread. Speaking to income taxes, Q2 2026 was tax inefficient, with a few non-deductible losses unable to reduce taxable income in profitable business units. However, this inefficiency improved year over year. Also, FTG incurred a $200,000 withholding tax hit on the repatriation of some cash from a foreign subsidiary. I would like to remind everyone that FTG continues to have substantial tax losses available to offset future income, and the accounting benefit of these losses has not been recognized in our financial statements. These tax loss carry-forwards are located in both the USA and Canada, with the Canadian losses recently acquired in the acquisition of Flight in December 2024. Regarding our financial position, FTG maintains a strong balance sheet with our net debt position as of Q2 2026 at $2.9 million, as compared sequentially to net debt of $4 million as of Q1. This leverage ratio represents 0.09% of trailing 12 months EBITDA. Free cash flow in Q2 2026 was $2.7 million as compared to negative $5.5 million in Q2 2025. Capital expenditures were $0.9 million as compared to $1.3 million in 2025. Going forward, we expect CapEx to be closer to FTG's long-term target of 3% of revenue, notwithstanding any significant capacity increases. As of the end of Q2 2026, the corporation's primary sources of liquidity totaled $85 million, consisting of working capital of $61.8 million and $23.3 million of unused credit facilities. FTG has plans to improve cash efficiency and minimize stranded cash in various business units. Accounts receivable days were 60 at the end of Q2, up from 55 at the recent year-end, due to timing of a couple of customer payments and top-line revenue growth. Inventory days were 112 at the end of Q2 2026, up from 105 at 2025 year-end to address order fulfillment in upcoming months. And accounts payable days outstanding were 57 at the end of Q2 26, as compared to 58 at year-end. Transitioning to our future outlook, FTG's book-to-bill ratio for Q2 2026 was 1.64 to 1. We enter Q3 2026 with a record backlog of $193.5 million, of which approximately 66% is expected to be converted to revenue in the next 12 months. The new business activities in both the aerospace and defense industries are strong and continue to accelerate. Both the circuits business and aerospace business are increasing throughput and winning their share of customer RFPs. Last quarter, we noted program awards for 2 substantial classified defense programs. We have since received the opening POs for delivery in 2026, though these orders are only a fraction of the annualized volumes. I should note that FTG's reported backlog only includes POs received and does not include program awards with estimated volumes. As we approach the midpoint of Q3, we are focused on managing cash flow and improving operational efficiency, and continuing with the Aero Calgary revenue plan, which is already bearing fruit. I should note that our complete set of quarterly filings are available on sedarplus.com or on the FTG website. With that, I would like to turn things back over to Brad. Brad?
Thanks, Drew. Let me delve into some important items for the future of FTG that will continue to build on our past accomplishments. We will continue to pursue growth in the defense market. As noted previously, we expect defense spending to continue to grow in Canada, in the U.S., and in NATO. We have seen some good success on some new classified programs in the U.S. last year, and we're pursuing more new programs in 2026. We are seeing volumes ramp up in many areas, including electronics for various weapon and electronic warfare systems. Beyond this, we will look for opportunities outside the U.S. as well. The NATO budget was about a third of the U.S. budget a decade ago and is two-thirds today, so it's definitely a market of interest to us. As Canada ramps its defense spending and its commitment to NATO, we are hopeful that it will create new opportunities for FTG sites outside the U.S. After the U.S. and NATO, the next biggest defense market is India, and as we get our site established there, we will look to capture some market share in this market too. We will look to capture more work in the commercial aerospace market and grow as volumes ramp up. As part of this, we will look for ways to increase our activity with Airbus, as they are the stronger performer right now. To do this, we will leverage our Canadian and China sites. Given the uncertainty regarding tariffs from the U.S., we will look to continue to diversify our revenue streams for our non-U.S. sites. Some of the items I already mentioned will assist in this, but it will remain a priority action for us. We will increase our sales staff outside the U.S. in 2026 to help drive this growth. Tariffs are now impacting input costs in our circuits business. This is because a lot of materials used in our manufacturing processes originate outside of North America. The impact is highest for our U.S. sites, but Toronto is also impacted where materials ship via the U.S. to Canada. We estimate the overall cost impact to be in the millions of dollars in 2026. We have started to work with our customers to pass on these increased costs to them and to the end users. Also, for our circuits business, we are seeing significant cost increases on input costs, mostly driven by circuit board demand related to AI data centers. Costs are moving up fast, and again, we are working towards passing these costs on to our customers. But it is tough to keep up with the rate of cost increases we are seeing. Also, our collective agreement for our unionized staff in our Circuits Toronto facility expires in July. Negotiations are ongoing, and we are hopeful of a successful conclusion, but nothing is firm until a contract is ratified by the members. And we will continue to take steps to create value from our acquisition of FLYHT last year. As of December 1 last year, we have renamed the business FTG Aerospace Calgary, as we amalgamated it legally into FTG. The amalgamation was done to possibly enable us to use the FLYHT tax losses beyond just our operation in Calgary. But to be clear, we do not have certainty that this will be possible. In the Calgary business itself, we believe we are now well positioned to have a strong year as a result of our product certification and STC efforts last year. We are seeing strong demand for all three products, and our pipeline looks robust. The licensing revenue on our SATCOM radio product has returned and should be reasonably consistent going forward. The licensed product ends up on Airbus aircraft, so we know the demand is strong. We are working to become the manufacturer of this product for the licensee to capture additional margin from this product. If things proceed as anticipated, this will benefit us in 2027 and beyond. We are looking to manufacture the SATCOM radio product in our Chatsworth, California facility. The production area is set up and parts are on order. This should help get our Chatsworth facility ramped up going forward. The Edge Plus WQAR has the key STCs in place. With our first few orders or few deliveries behind us, we are quoting many new opportunities in a number of geographic jurisdictions. And we are starting to manufacture this product in our Tianjin plant to enable us to capture this margin as well. We expect sales of their weather product to ramp up in the second half of 2026 as well, with our contract with NOAA in the U.S. Our contract with the UK Met in England was unfortunately cancelled in Q2, but not for reasons related to the product. While disappointing, we continue to see strong potential for this product elsewhere, including some military applications. In Q2, we installed our first kit for this product on a WestJet aircraft, and we expect to have our STC for the 737 MAX in Q3 this year. Once approved and installed, there will be a recurring revenue stream as we provide real-time weather and water vapor readings to NOAA. We also expect to install further units with WestJet through the balance of this year, each incrementally increasing our recurring data revenue potential. These actions should enable FTG Aerospace Calgary to be a positive addition to FTG and further mitigate the risks from U.S. tariffs. We opened our aerospace facility in Hyderabad, India last week. Our decision to expand geographically was partly us looking for an insurance policy against anything negative happening in our China operations, but it was also partly to expand into a new region with growth potential. As we analyzed our options, we concluded India was a very cost-effective place for manufacturing, and with Prime Minister Modi's Make in India policy, coupled with significant defense spending, it would be an ideal place to operate and a place where we can serve our existing Western customers, but also penetrate the Indian aerospace and defense market. We selected Hyderabad as it has an aerospace hub primarily focused on manufacturing. After our grand opening last week, we attended an aerospace conference in Hyderabad and came away with some exciting new customer opportunities. While we held our grand opening, we are still sourcing some necessary equipment to be ready to go. Our estimated total investment is forecast to be approximately $2 to $3 million. While not the original intent, we believe this initiative could also help mitigate any negative impact from U.S. tariffs. Through the balance of this year, we will be staffing up and training and building some initial products, but it's expected to be intercompany activity, so no real incremental benefit to FTG before 2027. We continue to assess possible corporate development opportunities that could fit with either of our businesses. We have a few areas of interest, including establishing a footprint in Europe, growing our presence in India, or expanding our technology in a few areas. In our second quarter, 3 circuit board manufacturing companies were sold in Europe, but none of them to us. TTM bought 2 companies, but neither had a strong focus in aerospace and defense. Somachis bought ACB Circuits, which is a multi-site business focused on aerospace and defense, but their operations are primarily in France, and this is not a jurisdiction we are keen on. And finally, as a reminder, our third quarter is seasonally a bit softer due to increased vacations and lost production days. We estimate about 1 week or 8% of lost production in the quarter. With a focus on operational excellence in all parts of FTG, our strong financial performance in 2025 and the first half of 2026, our recent acquisitions and our key sales wins, we are confident we are on a strong long-term growth trajectory. This concludes our presentation. I thank you for your attention. I would now like to open the phones for any questions. Vincent.
Ladies and gentlemen, we will now begin the question and answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. Again, that will be star, then the number 1 on your telephone keypad. If you would like to withdraw a question, please press star, then the number 2. Your first question comes from Nick Boychuk from ADB Cormark Capital Markets. Please go ahead.
Thanks. Good morning, guys. Brad, you mentioned a lot about the outlook that you have now in this increased booking backlog activity. What's the confidence you have to deliver, given the existing footprint and labor availability? Are there any bottlenecks or things that might prevent that from flowing through over the coming 12 to 24 months?
Yeah, for sure. There's always challenges and bottlenecks and such, and it's different across the sites. And I guess all sites but one, it's about staffing and training and getting people operating equipment more hours a day. And so for every site except Circuits Toronto, it's about that. And I tried to allude to it, but the key for us, one of the keys is Minnetonka, and we've been struggling to make that happen, but we didn't see the result in Q2, but we saw significant improvement in staffing in Q2, which I believe is going to help us going forward in Q3 and beyond. So that was really good to see. The other sites, to their credit, so Chatsworth grew 18% with a handful, a couple of staff additions. Fredericksburg grew almost 100% with no staff additions. Haverhill grew 15% with no staff additions. And so, the sites are really performing well, and we will add staff as necessary to support future demand. And then finally, on the last one on the circuit side, so our Circuits Toronto, for sure we have some production bottlenecks that are equipment related. So we're already running 24/7, so that's not an opportunity to just run it longer. We are working to address the equipment bottlenecks. We have orders in place for some expansion in our plating line. We have orders in place for some drills to expand our capacity there. our only challenge, which might delay it a little bit, but it's just the lead time on equipment is pushing out a bit, just given the overall demand in the circuits industry. But everything's on order. We are hoping that we can add $20 million plus in capacity by the end of this year. And then on the cockpit product side, it's all about staffing, and we're doing a good job supporting our demand right now. As I talked about, we just opened our Aerospace Hyderabad facility. That's adding another $20 million of capacity there. So I'm giving you the world's longest answer, but at the end of it all, I think we are doing the things to be able to support the demand we see for the coming couple of years.
Okay, perfect. No, that's great color. Thank you. And as those start to play through, how are you thinking about margins evolving? I know you're obviously adding this extra equipment to remove some of these bottlenecks. Where could either gross or EBITDA margins, as that operating leverage starts to play through, really go here?
Yeah, I don't know. Here's my challenge. I had a long-term target at FTG. These are mostly internal targets that I could get to a 30% margin if I had blown way past that. I have a target of getting to a 20% EBITDA, and we're basically there now. So I've run out of targets. I got to come up with some new targets. But at the end of it, we are a manufacturer. We've got a bunch of fixed costs. If we grow the top line, margins expand. That I know for sure, and we keep demonstrating that. We can perform efficiently and productively, and obviously we work on doing that wherever we can. But top line drives bottom line at FTG. So if we can grow the top line, margins will expand. I honestly don't have a target for you today.
Okay, that's fair. And then the last one for me. On these classified programs, is there any color you can share? Like, I appreciate that the end application and the use case of some of this hardware may not be even known to you guys, but in terms of either the scale of the contracts, the velocity with which these orders are going to come through, or even the tenure, is there anything that you're aware of that you can share so we can kind of wrap our heads around how impactful these two contracts in particular are?
Yeah. Yes, I guess on the first part, just to be clear, I truly do not know the end application. So, can't share anything on that, but you didn't ask about that. In terms of the financial impact of these, they are both gigantic. Annual circuit board spend is, $50 to $100 million. Obviously, I cannot support that full spend, nor would the customers spend it all with one supplier. So we're going to get a portion of that, basically whatever we can support. But we're early days. One of them, we have orders, we've shipped nothing yet. And we're actually still waiting for the customer to finalize designs. We built some prototypes last year, but they're doing back in redesign. And so we're just waiting. Can't really begin to guess where that one's going to end up. The other one, started production, but low numbers, nothing meaningful in Q2. And that one's in our Toronto facility. But I don't know. It's going to depend on how fast they ramp, and then, to be fair, how we perform. So, we're working to try to make sure we perform well for both of them and get our fair share of the pie. But TBD, the exact timing on how this ramps up, and after that, for sure, they're both multi-year programs, 5+ years.
Okay, that's really great color, guys. Thanks so much for the time.
Okay, thank you.
Your next question comes from Steve Hansen from Raymond James. Please go ahead.
Yeah, thanks for the time, guys. I just want to follow up on the defense programs, Brad. We've obviously saw a step change in the backlog and the bookings. I presume some of that references the new POs coming on from these programs. Is there any sort of color you can give us in terms of how you expect these programs to ramp, or what pace through the back half of even just this year? That'd be the first step.
Yeah, as I say, there's a little bit of uncertainty right now. One of them, we're waiting for a redesign. You just never know how fast that will happen. But just starting with the backlog, so our backlog ramp $40 million. Probably half of that was related to these two programs, approximately. So it's, significant in terms of the orders. They're indicating this would be due basically through this year into early next year, so I'll give you a bit of timing on it. But that timing can move. You've learned this many times when there's a new program and it's trying to get into production. Typically it doesn't move faster than you expect. Typically you end up with a handful of delays because something goes wrong or something doesn't work quite the way they expected. But, they're moving aggressively. The customers are moving aggressively on this. Clearly they're being driven to get it to market as fast as they can. But again, there's just a little bit of uncertainty.
No, that's fair. And then just switching gears a little bit, I know you talked about the broader corp dev backdrop and some of the transactions that took place in Europe. I know you've been on the hunt there. Could you perhaps maybe just describe how your pipeline looks at this point, or maybe even characterize your efforts to search out potential partners thus far?
Yeah. Sure. And, it depends how you determine a target. There's probably, at the end of it all, I'm going to say roughly 10 companies that are of interest to me, in that, they're in Europe, they're in possibly a reasonable jurisdiction of Europe, they're focused on aerospace and defense. But that doesn't mean they're available. That's kind of the targets I've identified. And then, I don't know, it's the never-ending game of acquisitions, right? Either they're willing to talk or they're not. And then, are they going to run a process or not? So we're seeing some of that happen, and I just don't know how it's going to turn out yet. So I don't know how valuations are going to be. That's certainly been a topic in the past of, will these valuations be reasonable? Don't know for sure. And so time will tell. And the three that sold, I have seen nothing on valuations on those. They were private deals that have not, the details were not announced, so it's not helping me on valuations either.
No, understood. That's helpful. And then just lastly, and I'll turn it over, I just want to go back to the question on capacity and bottlenecks and labor. Are you done, maybe as the first part question, are you done with the shuffling or the shifting of work you described? Fredericksburg nearly doubling production, Chatsworth Haverhill also taking up production with it sounds like you've been quite successful in shifting and moving work. Is that process largely optimized thus far, or is there more to go? And then on the second piece is just that you also described you're still searching out some new defense programs over and above those that you're there. And so just maybe give us a sense for where you think those can fit into the network as it stands in terms of your current sort of, future capacity pipeline. Thanks.
Yeah. Okay. I guess first one, in terms of shifting work, we actually did have some success, which was good. For sure, we're not done. It's a never-ending process. I think we're forever optimizing it. It's remarkably painful working this through with customers. It's the nature of the business that when you're moving aerospace or defense product around, customers are cautious. They want lots of approvals and they want to check everything and be, very cautious in making these moves. So it takes longer than we'd like, but nevertheless, we continue to do it. Some of it is to manage capacity. Some of it's to manage, tariff-related stuff. So trying to move non-U.S. work out of the U.S. or U.S. work into the U.S., that type of stuff. But that's ongoing, and we'll continue to work it. And then your second question, I don't know. You should ask that second question again.
Oh, just in effect, if you've got a large backlog of pipeline already today secured, but you're also on the search for some new programs, so do you ultimately have places to stick it or fit it into the network today?
Yeah, I am actually the Q2. I talked about lots of interesting things going on, but Q2 was a good quarter for us, and the sites really performed, and they ramped. And some of the, I'm really encouraged by that. I believe we have room to continue to ramp. And again, it's just keeping the equipment moving more hours a day. In Chatsworth, circuits, for instance, I was running 1.5, not even 1.25 shifts. And so if I add some people, the equipment runs more. I think I could do a double in Chatsworth, not overnight, but I could do a double. I think I could do a double in Haverhill, not overnight, but a double. I did a double in Fredericksburg. I think there's potential to do another double. Again, it's not overnight, but in terms of plant and equipment, I have capacity. It's supporting it and staffing it to keep the equipment running. But yeah, I'm happy to chase more work and put it into those types of sites, and even Minnetonka. They could probably add 30% more capacity with staffing properly. So takes work, takes effort, takes a bit of time, but yeah, I can find places to put new work for sure.
I appreciate that, Brad. Thanks.
Okay. Thanks, Steve.
Again, if you would like to ask a question, simply press star, then the number 1 on your telephone keypad. Your next question comes from Russell Stanley from Beacon Securities. Please go ahead.
Good morning, and congrats on the quarter. Maybe a follow-up on the last question. Understanding staffing is and has traditionally been the gating factor, debottlenecking in Toronto being a priority, but customer qualifications and any sort of regulatory certifications, those are facility specific. I'm wondering, can you talk to your current setup? Are there any meaningful qualifications or certifications that you're lacking for any facilities that otherwise preclude you from reallocating work to them? Is that at all a gating factor, or is it really just the staffing in other facilities and of course the debottlenecking effort in Toronto?
Right. Yeah, I guess the obvious one for sure, there's a bunch of work we need to do on certifications for our Aerospace Hyderabad facility. It has no certifications. And so, that one is what, we're hoping to work on through the balance of this year. It's great we opened it, but we got to add some people, but we got to get the certifications in place and the customer approvals in place for it to really contribute to our overall capacity. But other than that, not really. Certifications is not an issue. So then it comes back to staffing, and like, I don't know, truly, I was really happy in Q2 in Minnetonka. It didn't show in their results, but their staffing activity and their staffing success was dramatically positively changed in the quarter, and we were, I think, plus 20 people by the end of the quarter at that site. And the target we had for that site this year was plus 28, so to do 20 in the quarter was huge. And so, we got to keep them, we got to train them, so it's not an instant overnight event. But again, they just really hit it out of the park in terms of their success on staffing as compared to what we've seen in prior quarters.
That's great. And just following up on India and your comments around H2, amongst the other efforts, you've got to get the facility qualified. When in 27 should we envision that facility producing net new orders, so to speak, no longer ramping up with reallocated work from other facilities?
Yeah, I don't know. We'll see. So, we want to do it as soon as we can. I'd love to be, having it positively contribute at the beginning of 27. That might be a little aggressive. Again, we're got to staff, train, and get certifications. The wild card, we're going to get the standard certifications, kind of industry certifications, AS 9100, that type of thing. That for sure, our goal is to get that done this year. The wild card is customer approvals. And I don't control those. We're going to start working on that, but, and I've said this many times on these calls, a customer approval can be done in a few months, or, my worst case is it was 5 years to get a customer approval. And so, we're going to work it, but that timeline is more uncertain than not within my control.
Got it. Maybe one last question for me. We just saw sort of press releases related to expanded production of missiles and munitions in Europe, in the U.S. Pentagon looking for $21 billion in supplemental funds for munitions. I'm wondering in circuits, can you talk about what you're seeing with respect to demand, specifically whether you're seeing any sort of replenishment demand come through given the use of these things in the conflict in the Middle East and Ukraine as well. I'm just wondering if you're seeing that additional tailwind start to filter through at this point as far as your demand picture goes.
Yeah, we're definitely starting to see it. I'm going to say it's a bit of a combination of quoting it, but multi-year quotes on this type of thing, and some orders. Definitely some of our 80-some million dollars of backlog was initial orders on replenishment of electronics for various weapons and warfare systems.
That's all for me. Thanks again. Congrats.
Okay. Thanks, Russ.
There are no further questions. Presenters, please continue.
Okay. Thank you all. A replay of the call will be available until Monday, August 17th. That the numbers noted on our press release replay will also be available on our website in a few days. I thank you all for your interest and participation. Thank you.
Ladies and gentlemen, this concludes today's conference call. Thank you for participating. You may now disconnect.